back. Merry Christmas. Um, it's good to be back. I've been traveling a bit and took the birds with me, and all the dogs are also stressed. Now they're back home in sunny Florida. No more cold weather. And we did some hunting, and we hunted birds. I know that sounds very contradictory. My family was questioning whether I was missing on some of the hunting trips because I didn't agree with hunting birds any longer. But I guess, yeah, that does seem like a contradiction. I enjoy the hunting, but I do enjoy my pet birds as well. So it's all in the details, I guess. This has been a big week in the markets, always a big week. I think we had this regime change recently with the dollar and the interest rates, which we didn't call the lows on those two. Bummer. But slowly repositioning all the positions I have to reposition at the appropriate time. From shorts to longs, I guess. And crypto. My crypto sector is doing well. And stocks. Stocks are interesting. Try not to talk too much about stocks, of course, but very interesting markets. I read a lot of Twitter, of course, and everybody has these opinions, and it just sort of makes me laugh where I'm doing all these trades with all these positions, and I really don't care too much about formulating an opinion of why this is happening. Oh, it's a fake rally. I've got shorts on too. Those shorts will be happy if it does turn out to be a fake rally. I was particularly interested this week in a couple of podcasts. Richard had a great podcast with Simon. I'm interested in his comments and clarification on all of that. It was really good with the synthetic data. And I have some questions on that as well for Richard. And then I tried to listen to all of Niels's podcast this week. Oh, and I'm looking forward to, I guess, tomorrow with the big reunion show with all the top trader unpluggers out there. Hopefully next year Moritz will be included in that. He should have been included this year, but it'd be interesting to hear what Richard has to say against those 7 other guys. And but anyways, the podcast this week, Niels talked a lot about volatility, low vol, high vol, the Quantica paper. I found that kind of interesting, and wanted to clarify and even possibly correct. I'm joking, but it's a good thing to talk about. I really enjoy Top Traders Unplugged, and I will apply for the job, though. I think I've mentioned this before. There is a job opening there it should be a job opening, and it is for a person to be sitting on the sidelines, correcting everyone, commenting, clarifying. What the hell did you mean? Or challenging every now and then. So I'm definitely putting my hat in the ring for that one. Oleg, how are you doing this morning?
How? Hello, Jerry. Hi, Jerry. Hi, Moritz. Hi, Richard. Hi, Absolute, Bruno, and all the guys I seen here and said, Ricardo, Cardura, and oh, hi to everyone. I am as always. I'm very happy to be here, and I want to say that I want to congratulate Jerry with 40 years an anniversary in high alp in trading because and I'm sure that Jerry is uh, the best trader in the world because we have no evidence um, of modern traders who trade for 40 years. I did not found such a trader. For example, Jim Simmons, famous Jim Simmons, uh, launched his fund near 40 years ago, as I know, but he now retired. He don't trade from 2009, and Jerry trades for 40 years in all these unreal, unpredictable environments, a lot of different environments, a lot of crises, and we can see this performance, and it's the best evidence of success. And I'm sure that Jerry is the most successful, and it's not emotional. It's not emotional. it's only it's math. It's math, and I'm sure that Jerry is the best trader in the world. I'm absolutely sure that is so. It's pure math. And also, I was listening Tested Trader podcast, as I remember, with Jerry, and I want to read my note from this, and it's a great one. Jerry said on 8 minutes, have good rules, not too many, one entry, one exit, and a stop loss. That's enough. I like to use the breakouts. I have a breakout entry, breakout exit, and then a stop loss, which is multiple of ATR. And then follow them. Follow those rules and make your bottom line. If someone asks you how well you have done, you have to answer them in terms of how faithful you have been with following the system, not how much money you have made or lost. And it's really a great one, really very great, because only in one of this quote, in these few sentences, there is a key to be extremely successful. There is a key, a big key of understanding this, that when someone asks how are you doing, tell this person how do you love your system, how you follow it, how good your system is. Yes, and every week, not every week, every day I think how happy. I have told this many times. I think how happy a person I am because I'm a trend follower, because I have met Jerry. I have have discovered top traders unplugged in 2019, and this wisdom of Jerry, of Maritz, of Niels, and I have found this wisdom. It was my dream, and my dream was achieved. And I'm very happy because all of these circumstances. I'm very happy because I decided to be a trader, and in January it will be 17 years since I'm a trader. 17 years I trade the global markets, and I did not see something that is better than classical trend following. Even if you are a short-term trader, and I know what I'm talking about, classical long-term trend following is a great foundation. And if you understand this great foundation, and if you know how to operate this, you can be also a good short-term trader. But if you are only a short-term trader but don't understand how classical trend following works, how the market works, it's not. You can be in a trouble. So, so again, I'm very happy to be here, and let's get started. And I'm very happy that these days before Christmas, before New Year, we are together and we will talk about our favorite topic, our trend following philosophy. So let's get started.
Like, yeah, that was interesting. I did see that quote of mine out there a lot this week on Twitter, and I did cringe a little bit because I think that that only goes so far. I think when you're sort of, at least initially or in the short term, over a short period of time, you definitely want to not beat yourself up too bad about losing money, and just make sure that you can give a good positive answer to how great you've been at following the system and following your rules. But obviously, eventually, no one's going to pay attention to you if you're following the rules and you're not making money. So that idea goes only so far. And probably I was talking in the context of when I first started. That's exactly how it was. Follow these rules, do these trades. You'll get in trouble if you make money and don't follow the rules, which no one ever says in real life. Uh, and then we had we would even lose money sometimes, and because we were following the rules, we would get more money to manage. So which doesn't exist in real life either. So, anyways, Jake, I was a little. I don't know if what I actually said on that. I didn't go back and listen. I think, but definitely, as systematic traders, we definitely want to grade ourselves on how well we followed the rules, and hopefully that will lead to good performance as well. Good morning, Moritz. Are you? I know you expressed an interest in that Niels, the podcast that Niels had with. I can't think of the the guy's name.
Hey, good morning, good afternoon, wherever you are. Merry Christmas, first of all. Last session before Christmas Eve. 2 days to go. Pretty good, pretty cool. Um, yeah, so I'm on the podcast. I didn't ask to be invited. I didn't know about the show. I'm not upset about it. It is what it is. Maybe next year, but maybe I would have. Thrown too many curveballs into the discussion. I don't know. Richard can comment on this. But yeah, there's an episode going to be released, I think, next week on the Open Interest series, which I host with Scott Curson from Gresham. I hope you like that. I did speak with him about all these alternative markets and why they trade them and why they exclusively focus on not only the alternative markets, but also only the commodity alternative markets. So they wouldn't be trading interest rate swaps or exotic currencies, but only the alternative commodities. And I mean, as you know, and Jerry and Richard and I and many others have put this forward many times, that we think that we should be trading all markets, as many markets as we can find, hopefully uncorrelated, but every single one of them, when we add it to the portfolio, will have a tiny bit of a diversification benefit, which is free for us to harvest. So we should really take it. And so Scott responded to that, and you will hear it when he answers, or when you listen to the episode. He said, "Well, that's actually not true. You need to make room for markets which have better trending properties and a better Sharpe ratio in a trend following trading context. So therefore, it's like an opportunity cost, is how he called it. If you're trading the 10-year note futures contract, which has a whatever Sharpe ratio of X, and but you have, as an alternative, you can trade glass in China, which has a Sharpe ratio of 2X, then you really need to kick out the 10-year note because it's only half the Sharpe of the glass future in China. Sure, that kind of like, mathematically makes sense, but only up to the point where the X and the 2X relationship breaks down, and it's no longer true that one is twice as good as the other. And this to me is kind of like this. It would almost be. It is like predicting. You're essentially saying that one market is going to do better in the future than another market, based on the systems that you're trading, and that to me is a statement that I would have a lot of stomach ache making. So, but that's their views. It's cool. It's marketing. It's different. It's operationally cool to handle and talk about these markets. Like, they make a big secret out of it. I asked them after the podcast, like, if they could share some of the markets that they'd be trading, and they kind of like, it's a state secret. Nobody's allowed to even get close to their market universe. It's like, oh, well, there you go. I guess I have a pretty good idea anyways, but fun podcast. So yeah, that's that. And if you give me another 2 minutes, market wise, it's been yeah, an exciting, challenging December for our portfolio here. The reversal in the bond market has resulted in give back. We published our letter yesterday from Tucker Hay. It's kind of like, when you zoom out, we've had such a great time on the 10-year note and on all these short bond futures positions. These trades are going to go down in the history books of my trade statistics as absolutely great trades, no doubt about it. We will close them with a big profit when all is said and done. It's just that the final profit isn't going to be as big as the maximum profit, which is kind of like 5 weeks in the past. or 6 weeks in the past now, when the 10-year yield reached its recent high. So, but yes, it is this inconvenient give back, and we got kicked out of short bunds, the shots in the bubble. I have now a long position in the bunds. I don't have a long position in shots yet. I'm still short some of the U.S. bonds, but and the Canadian bond, but most of the other bond markets I'm now long. So there you go, changed quite quickly, and add to that the reversal that we've seen in some of the currencies, um, some of the equities as well. It's just this. I'm not sure if it is a pivot, but the market, the people interpret it as a pivot, and everything is just rallying, and we didn't have enough fuel in our equities, and anyway, it's not the first rodeo. You know how it is. But what's interesting, and by the way, this is such an interesting period because it's Christmas time and liquidity is thinning up. Oftentimes you have this Santa Claus rally. I'm not sure if that is really a thing, but people talk about it. And what we've also seen many times is that in the first 1, 2, 3 weeks of the new year, there's a lot of capital redeployed, and oftentimes that has resulted in a big up move in risk assets. Not always, just more often than not. But there's also this, like, when you ask me as a human being, and but I follow the system, so you may ask me whatever you want. But you kind of look at this, and it's like the rate cuts are priced in 50, 75 to 100 basis points next year, kind of like as a given. But inflation in the US and also here in Europe is still well ahead of 2%. And I'd be, I'm not sure if anybody's going to be lowering rates if inflation is, north of 2, because there's a reputation risk for the central bank if they did that, like if they lowered rates before they've even reached their target. So there is this risk of a reversal again in the bonds. They could be trading lower again, and maybe that starts in today. There's a number released, or next week, or whenever, and then we'll be wrong-footed and we'll get out with a small loss again and go short again. It's just this period that we'll probably work through. But look, the system tells me that right now the path of least resistance is to be long some of these bonds and short some of the others, and so that's what we do. Then, sorry, give me another minute, but I thought maybe you'll find this interesting. But as you know, we launched a fund in June of this year, and when you do this, the question of the decision that we had to make is kind of like, what are the initial positions going to be? And let's just say you run a backtest of my system with a start date of whatever, like 2000, like 23 years ago, 22 years ago, or 10 years in the past, something like that, right? Then that system would have opened a short bond position in most of the bonds in kind of like, early 2021. So more than 2 years ago. And back then, the average true range of these markets was very small because interest rates were very low, 0 or even negative. So you had the appropriate position size on at the point in time, which was relatively large. And you implement that trade. That trade starts to run. You build up a lot of open trade profit. The stop or your exit is many ATRs away from where you entered the position. So you sit on a lot of give back potential, if you will. But that is the position. That is the position of the system. And only if you implement that position with that size today will you track the percentage P&L every day of the system. If you don't implement that size, or if you choose a different exit level, or if you choose a different start date for your system, then you're not going to be tracking the true thing that you actually do want to trade. So, for instance, if I set the start date for everything to be the 1st of June 2023, then theoretically I should have a short bond position, but the system tells me, oh no, you're only starting today, so we need to wait for a new low, like a new end day low, before we open the short bond position in the 10-year note and all the other markets. So you'd only, over time, step by step, like piecemeal wise, get into these positions. And you would also, with the first position that you have a more concentrated portfolio, because it kind of like needs to stack up and find its signals and build up. So I didn't want to do that, and I therefore set the start date, somewhat back in the history, and so that has just resulted in a relatively larger position size than if I had started the system on the 1st of June, and therefore probably 100 or 150 basis points greater loss on that reversal in the bond market. So that is my December, but well, we're down whatever 4% or something like that, which is worse than most of the other CTAs. But that's it. We're now cycling through the portfolio. We have all the positions on that we want to have on, and next year we're off to the races again. Thanks for that.
Moritz, can I ask you a question about that?
Sure.
You said that you create a backtest and then you implement the positions that the backtest will tell you to have. For example, you run it from 2000 or something like that. Where I think it's correct. But my question is the following: do you use back adjusted series to run that backtest, or do you
Sure.
use that one? You don't use each of the, especially if you run long-term systems. Do you use back adjusted, or do you use the current contracts?
I create a back adjusted time series for each market. So I take out the roll differential, and that time series is the one that I'm applying my system on.
Great. It will be in the last dates. It will be the same as the current contract.
Correct. So right. So the time series today, or the settlement of like yesterday in the time series, is going to be matching the current contract. But then if you go back in time, that starts deviating because of the basis that existed between one contract and the other at the time of the roll.
Thanks. I ask you that because when I started many years ago, somebody in nuclear finance told me, "You're using a back-adjusted series. You're trading something that doesn't exist," and that stuck in my head for a lot of years. But it happened to me that using back-adjusted versus using the current contracts, time passes and you run the backtest, and maybe a trade disappear or change, etc., which is something that I guess you have to live with. But I was curious if you, for example, I don't know, maybe you used a back adjusted series for the signal, but then you trade it on the current contracts, etc.
Yeah. No. That's how I do it. There's several different ways to do it, and some people may do it another way. I just think that back adjust for differences, not for ratios, but back adjust for differences, so you keep the same number of contracts, regardless of the basis. That is what I, at least for me or for us, have decided is what we want to do.
Thank you.
Hey, hi everyone. Merry Christmas. I was thinking we wouldn't have this conversation today, up to the point that Jerry put on the link. Really glad he did it. On this back adjusted thing, I believe I call it the Panama adjusting, and I find it most useful for the classic trend following approaches that we get, breakout trades or moving average. It's interesting that if you want to vol manage the thing, this kind of adjustment doesn't work very well, because at some point in time, the the contract may show a negative price in this adjustment type, and well, it's not really suited for that. But anyway, I do the same thing as Moritz is suggesting, I believe.
Well,
And
the sorry
yeah,
to,
go
to,
on.
to interrupt. I don't want to be apologies if I do, but the different prices that you get or can get when you back adjust for differences and you keep the contract size the same, right? That is not going to be a problem if you calculate your P&L as, today minus yesterday. So you
Yeah,
calculate a
exactly.
US dollar P, right? But if you did percentages, then that becomes an issue as soon as you cross the zero, right? And you're negative, or one leg is negative, or today's price is negative and yesterday's was positive, or the other way around. So so then if you want to work with these percentages, which I never really wanted to do because I can't implement percentages in my portfolio, I can't implement fractional contracts. The clean and kind of like honest, transparent way is really with just calculate the P&L as you would on a day-to-day basis anyways in your portfolio. And that is just, today minus yesterday times the point value and maybe an FX adjustment, and that's it. And that is why negative prices for us don't really matter.
Yeah, exactly. And the tops and the downs are the same anyway. It doesn't really matter. And if you're adjusting by percentage, everything gets strange at some point in time. But anyway, um, and the other topic you alluded to, um, the when you start calculating your back test to know the positions you should put on once you start trading, wouldn't you say that if you evaluate your positions as if you were running since year 2000, for example, the first trades you get may have a huge loss. Wouldn't that conflict with our golden rule of take small losses?
Uh, it's not going to be a huge loss. There is an exit. It's not. I don't think it can, have a position size that would really cause a disaster trade or any of these massive losses where you would create havoc to your portfolio, and that also didn't happen. But I think this is one of the discretionary decisions that you are essentially forced to make when you start trading. You have your backtest and kind of like the historical positions and the positions that you should have on today, but those positions may have they may have an age on them, right? They may have, in my case, because I'm so long term or relatively long term, these positions they may be live since say 200 days or 300 days or 400 days and something like that, right? So they have a lot of they have a time on them. They've been running for a while and they've accumulated P&L, positive P&L. So if you had invested obviously in the fund back then, 2 years or 3 years earlier, you would have enjoyed these profits. But now you're getting into the fund, and if you want to track what the system is doing, then you need to have that position. But obviously, I did know, and I was aware of the fact that the people that start investing on June 1st, they don't have the 2 year history that I had in my trading account, and they don't sit on these profits. They start from scratch, and for them it's a blank sheet, and off we go, starting with zero. So therefore, and if I put the full position size on, it's kind of like, yeah, that's too big. But where do you or maybe it isn't too big. Who am I to say? It is really it's a coin toss decision. There is no sample size. There's nothing that we can backtest to do this. It's you have to make that decision as a human being. It's kind of like, okay, when do you start your system? What's the start date and what's the position size that you start with? And once you've recycled or once you've cycled through all the position once, the issue goes away, right? Then everything's in sync. But on the day that you start, you just have to make that call. That call can be good. That call can be bad. Well, whatever. Bad isn't the right word. Even it's just it has an outcome. It has a result, and over time, it shouldn't really matter. It's just the inconvenience or maybe joy, if it works your way, that you have for a period of time as you have a little bit of a deviation from the theoretical performance, and then that stops and you continue.
Yeah, I started my running my strategy with real assets at some point in 2022, and at the time I decided the other way around. I decided to only put on the trades, execute the trades that were new signals, and to do that I started tracking the prices uh, some days before the the start of my strategy. So, for example, if I'm running a 50-day breakout system, I'm I start looking at prices 50 days before the start of the system. Uh, so that way, I was trying to ensure that no loss would be larger than the my allowed risk budget. I mean, if I risk, say, 20 basis points per trade, this way I'm losing up to 20 basis points per trade because I'm starting all of them from scratch all the time. The result was I was waiting for a new low for on the price of the bonds, for example, to start a new trade, and I was kind of late. I got whipsawed at some in some trades, and that's life. But as you said, it's a discretionary call in the in in fi- in the end. Um, what I'd like to share here is that because the nature of the trend following systems, because most of our trades are losing trades, what I ended up getting was a lot of whipsaw. I got a lot of losing trades um, from the start. So, well, in the before I did that, I thought, well, I'll get a fair amount of losing trades and some winning trades, but what ended up happening was a sequence of whipsaws. So just to say that it's not that one way would be much better than the other. You get your small losses, but you get a lot of them in a row, or you may get it.
Bruno, I was thinking that maybe an alternative that could be good is to use the discretion on on the NAV that you're using, right? Meaning that you know how sometimes people trade less when they are in a drawdown. Maybe you could trade less when you're starting, supposing that you're starting, and when the trade cycle liberates, meaning that positions coming from the backtest close and open again, you will add more and more closed equity to your new available equity to trade, and maybe instead of looking at that on a trade by trade basis, you could look at it on the full equity basis and liberating money to trade when the trades are clean, and you could have them whether you were a new investor, so to speak, or an old investor. I don't know if I'm clear.
Yeah, that could work. It would be similar to spreading out your investment in a trend following system over time. I mean, instead of putting all your money at once, you put some of it the first month and then some of it in the second month, and you spread it out through 6 months, 12 months, whatever.
Yeah,
But
but
then
it will
it's,
come from the rhythm of the system itself, right? Meaning that if you have a 50-day, that a moving hour, a breakup, etc., and the trade opens and closes, so now there is a new trade, you will liberate that assets to come to all the new upcoming trades instead of doing it on a calendar basis.
yeah, yeah, that could be a way to circumvent that. And well, honestly, I can't think of the trade-offs right now, but definitely an idea.
Yeah, but as you said, I think the main issue with trend following is that even if you're a knowledgeable investor, you will forget, or most people forget that there is a 70% miss ratio, which is that's very, very important because, as you said, you could get a lot of whipsaws, etc., and people will get nervous whether they understand the strategy or not. At the end, I agree with you guys that if you are in, you have to be in for whatever the strategy is carrying from the past. But that's easier said than done.
I've definitely implemented new systems with lots of open trade profit, and so not exactly what Moritz was talking about, but it's a really dicey situation. You have to be very careful because I implemented some new longer term systems once, and it was just a disaster. They had so much open trade profit. You try to put it on, and you look at the back test, what can go wrong, and yeah, it really just was a blow up situation. So I think that now when you have a fund and it's established, and you've got a sort of a multi-year track record, and new clients come in, then they're going to not take those small losses because they're in OJ, or they're short the bonds just after a long run down. And so when those bonds rally, they're effectively not taking small losses, but the fund is, and all the old clients are, so they're in good shape. So you've got that issue, which kind of people say, okay, that makes sense. But when you start a new fund, or in my case, I went from trading like a shorter term strategy to a longer term strategy. And the longer term strategy had done very well, had massive open trade profits, and our leverage was pretty high. Oh my, it just turned into a huge monster disaster. And so, um, that is something you have to take into consideration. Now you can adjust your trade level to an artificially low number, let's say, and say, well, I kind of want to put all the trades on regardless of where they are. Let's just get it going. It doesn't seem to be as radical as what Jerry's talking about. So let's just trade really small. And then as time goes on, we'll increase our trade level. Or you can pick and choose the trades. There's really no good answer to any of this, in my opinion. When I um, when I started the ETF, I just threw all the positions on. We had the other track records that were going to be parallel to the new ETF. So people could sort of look at the other funds and say, okay, I'm going to kind of mentally look at the recent performance, look at the current drawdown. Um, so the ETF is just starting. It's running in parallel to the other programs, the other investment opportunities. So I will maybe take some solace in that. But it is a dicey situation. And yeah, pretty. It's not a good situation to make those choices. I'm not sympathetic though at all to the idea. It's just my own personality. I think Moritz and I disagree on this issue, but I'm not. I don't look at it as, well, this is what the system tells me to have on, so this is going to rule the day. I mean, that's optimally it's what I'd kind of like to get to quicker, sooner rather than later. But I'm not going to be forced into throwing all those positions on based on that. I've got to have to nuance it, finesse it a little bit more. Yeah, it's a bummer. But people, and then if you make money and things keep going, which is what you kind of want to expect, which everyone expects, you're going to be left behind, sort of explaining to people that you're lagging behind because you were trying to be responsible. So there's no good answer, and I think. But this is something people need to know and look at, come in with open eyes. I sort of threw people a huge curveball. So my behavior was not defensible. I was crazily way too risky in my situation, switching systems radically, going from sort of short term, medium term to super duper long term. So yeah, it was just a disaster. I do want to talk about. Darn, I wish Richard could talk today, but I do want to talk about the thing Moritz was talking about with Floor and Court and the. Yeah, this is a fascinating topic. It just is. One of the things that we make fun of is native futures CTAs, or at least I do, and all the differences. And we sort of just pretty much talk about the vol management, correlation management, dynamic position sizing, uh, claiming to care about risk and volatility, but really just using that to take profits. But this is another good example of how there's so much different than the way that I was taught to trade. I'm not even sure if it's a classic versus non-classic, but it is a lot different. And that is this whole idea of, well, I wanted Richard, maybe Moritz knows, but I've even heard Neil say that the application of Sharp to individual markets or even to a CTA portfolio is not correct, that it's supposed to be applied to a whole portfolio. So it's stocks, bonds, allocation to managed futures, private equity, whatever. Then you bring all of these markets together and then you calculate the Sharp. And so maybe you're not even supposed to use Sharp. Well, of course, I don't like using Sharp to measure trend following results, but so now they're measuring, they're calculating the Sharp for each individual market. Wow, that is quite amazing because I was taught you're supposed to trade all the markets the same, and all markets have the same expectation. Add the markets to the portfolio because they're giving you some diversification, and don't stop trading the markets that haven't been good recently because all trades have the same expectation and they may be good in the future and they have outliers in the future. So this is a very big difference between, and then using any methodology to sort of say that the markets are better than other markets. Wow, that's pretty unbelievable. Now, I will say that about indices, of course, that the stock indices are worse than the individual markets that make up an index, whether it's dollar index, commodity index, or stock index. So I'll definitely say that because it doesn't sound to me to be very legitimate to combine a bunch of markets together with some sort of algorithm and then say, let's trend follow that. So I don't like that idea. It's not too far away from, let's just, as a CTA, trade 100 markets long only and trend follow that. Allocate how much we're always going to be long, and then we'll trend follow that index. All of it's silly, doesn't make any sense. But so now they're picking out markets and declaring them superior to other markets based upon the Sharpe ratio. I would not be against some sort of back test that looked at a group of markets in China or, I don't know, the less liquid markets maybe, or some of these OTC markets that make up the 500 that they trade that doesn't include the regular New York and Chicago and London markets and the other markets we trade around the world, and sort of compare those two. But it does seem very dicey. And as Niels would say, it doesn't seem to hurt their performance. All this fitting, I think, doesn't seem to hurt their performance. So I don't know. Trend following is pretty powerful. So when you're doing things much different or slightly not as robust as other people do them, and you're still doing really, really well, I guess that's the power of trend following. I don't know. What do you think, Moritz? Is anyone having trouble hearing Moritz, or do I have technology issues?
Oh, I think I do, but usually my technology is bad as well. So, well, I'm on this.
I don't know what that means.
Uh, we all know, I think, this technology problems, and you all know that I have often this problem. But I want to share some my thoughts about this. That I have said before that I use Apple technology, and it works better. I'm talking from iPhone, and it works better in this spaces, Twitter Spaces. iPhone better than Android. So it's my own view, but it's it works better. Here's my advice.
Yeah, sometimes I can't listen to new speakers. So, Moritz, maybe if you could go back to the audience and then back into the uh, panelists, maybe it will work.
What I found was my phone was doing an update to the app, and I just had to log off. So, anyways, I could barely hear Moritz. He was breaking up, but I didn't know if it was my Wi-Fi. My Wi-Fi is not as stable. Oh, anybody else want to comment on this idea of, oh yeah, Sharpe ratio per market? I know Bruno had looked into did some backtest research on different smaller markets or comparing those to the mainstream markets that we all, or at least most CTAs trade. But yeah, just when you think Sharpe is so bad and evil, and I write all those tweets about it, then they're like, oh no, we want to use Sharpe per market. Like, holy smokes. But that is what a lot of people on Twitter use, the traditional people. What is the Sharpe of this sector or this market? Let's add together a bunch of high Sharpe things. But that kind of goes against, I think, the power of diversification, of adding different things together and trying to improve that Sharpe and not making the Sharpe per instrument or per trader even. I think that's what the multi-strats try to do, is each and every manager has to have a high Sharpe, and if he doesn't, we'll get rid of him. But I think adding in a lot of different types of strategies that are robust over a long period of time and giving people the ability to actually execute those strategies versus a really strict money management of cutback or you're fired or whatever. It's got to be a weakness in their business model, but what do I know? Doesn't look like they have any weaknesses. That's for sure.
But Jerry, can I say something? I think that for implementation, it's of no use, but sometimes it's useful for people who don't believe in diversification, and they think, for example, that they could handle a Tesla long for a lot of time. When you sometimes can chart a running Sharpe of a position in Tesla against a position on a trend following strategy or in other alternative, and you compare those, although it's not the perfect chart, uh, they will see that when you adjust it for risk, and you could do that with Sharpe or with the MAR ratio, it's kind of using a base 100 chart, but even better. They realize that they are looking things after the fact, and they say, well, I could handle that position. But you say, really, when you adjust it for some kind of risk, look it in the chart and you'll see that it's no better than having a diversified trend following portfolio or something like that. I think that's the use, kind of an educational use, but not use in the implementation using Sharpe or any other kind of ratio on a mark-to-market basis.
As we've discussed the past week, I think Sharpe is an okay metric after you take into consideration all the other things that really matter. So in the end, if you get with a good Sharpe, okay, great. But if you don't, well, you shouldn't lose your head on it.
I like the idea of Richard, the words of Richard, that Sharpe, it's a linear measurement instrument of linear measure, and our processes are non-linear. Our profits, we have profits from our outlier. We catch hunters. We are outliers, hunters. So we catch the outliers, and so Sharpe is, and I'm sure that Sharpe is not good measurement for such strategy. And because we're divergent, we trade divergent strategy, non-linear strategy. And I agree with guys that with Jared, with Moritz, and with Niels, with Richard, that the best measurement is a track record. The best measurement is track record and maybe nothing else. But
Yes, sadly, it's not available for all of us, right? That metric. I think I'm trying to make my analogy more clear here. Sharp is like grades in school. If you get good grades, that may be a signal that you're an intelligent person. But once you start developing your game only to get better grades, it doesn't mean you're getting smarter. Maybe you're just tricking the system. That's what happens with Sharp. Sometimes you get a good Sharp, but a terrible strategy.
I've never heard that before, but I like it. I mean, that is really good. I'm going to think about that and think about some other examples. I like that a lot. That's good, Bruno. I wanted to comment on so much to talk about, but oh yeah, I wanted to talk about this one tweet from JoJo. Love JoJo Trader. My oldest daughter is named Joanna. I always called her JoJo. JoJo had this one tweet I wanted to mention. And it was interesting that in the early days of trend following, they did not have the luxury of 40 plus years of data. Still, they managed to come up with robust models. Was that luck? Well, I don't know about the luck part, but I do think that it is better to have a good back test. I mean, that's like the best thing to have. I mean, I was going to say it's better to have a good back test than a long-term track record, but I place the back test up there very highly. I mean, I love the back test. There's nothing better. You just got to do it correctly. And it is a great back test. And you can start trading tomorrow. No practice, a new idea, a correction, getting rid of some bad ideas. You wake up one day and you're like, one entry, one exit, and a stop loss. Of course, this is the reason I don't have good performance. I have too much fitting, too many different exits, not enough sample size. I'm going to run my back test with one entry, one exit, and a stop loss. Look at that. This is amazing. You start trading tomorrow. You're done. You're ready. No experience. That's good because since you have no experience, you're not going to talk yourself out of following this system. Okay. So anyways, let's get back to the 40 years plus of data. Still, they managed to come up with robust models. So the amount of data that a person has is one part of the calculating whether the model is robust, which means to me it doesn't have a good sample size. And I think I got buy-in from some people on Spaces. Maybe Absolute at one point gave me maybe he might have agreed with me. I can't remember totally. But and that is that a very robust system can absolutely not be profitable. So it's robust, nice going on the robustness there, but it's not a profitable system. And I think some people, I hear them on Twitter or whatever, talk about it's robust because it makes money in a lot of different time frames and different environments. Okay, it's probably true, but I don't want to steer too far away from my data, the number of trades we've done, and the sample size. So there you have it. I already spilled the beans, and that is, it's the number of trades you do. So back in the day, when the early days of trend following, those strategies were way shorter term than what's used now by CTAs and managed futures. So we picked up more data the past, now we have 40, 50 years worth of data that they did not have back in the 80s, 70s, but now we trade longer term. So we're not doing as many trades. Our our backtest doesn't contain as many trades as if you traded shorter term with less data. Or you have to take both of those into consideration. So this is the problem, and I think longer term looks great, but it doesn't do as many trades as shorter term using daily bars, of course, what we're talking about. And so if you throw stocks in, you can increase your trade stats, but they can be correlated more so than currencies, commodities, and interest rates, especially when the stocks over the past 20, 30 years have done really well. Since the 80s, stocks have done really well. So they're going to dominate the trade stats potentially.
And I think that it's very important to understand how system operates in different regimes. And I have said this before. So I think that we can have, for example, 10 trades in the market in a longer term system, and 1,000 in a year, for example, and 1,000 trades in a market in a shorter term system, intraday system. But if regime was the same, I don't think that this 1,000 trades in a short term system is a better measurement, is a better sample size than 10 trades in a longer term system in the same year, in the same regime. I think it's very important to see how system works in different regimes. And so so I don't think it's the right measurement that 1,000 trades better than 10 trades in one kind of regime, in one market. I don't think so. It's my opinion. We must see how system works in different environments.
So I can get into the tweets. The tweets I did of Niels and the Top Traders Unplugged last week. I really liked this quite a bit. Nick, keep forgetting his name, Nick. So yeah, Nick and there was a Quantica paper that they talked about, and they talked about volatility a lot. And this paper was making the case that trend following works well when the VIX volatility is high and when the VIX volatility is low, and maybe not as well when it's in between, I think. Okay, so I thought that was pretty interesting. But I went and read the paper, and I tweeted about the paper as well. And I'll read this. Generic trend following returns do not require high levels of realized vol. And since 2000, overall trend opportunities have been on average higher during low realized volatility regimes for equities, fixed income, FX, or commodities. Typically, trend following CTA positions are built on a volatility risk-adjusted basis. Lower volatility markets are levered up, and higher volatility markets are sized smaller. The positions are bigger when volatility at entry is lower. This is like the whole part of the paper that they left out. Okay, this is what I'm like, of course, volatility, the trades are usually going to be somewhat better. I'm trying to qualify this now. When the ATR entry is low, you're going to put on a huge position, right? And I've done research on this, and I've tried to exploit this. I think it's dangerous to use low vol, relative low vol, some sort of low vol measurement as a filter, because filters should be avoided. And filters, in some respects, will get you to not do a trade, to miss a trend. So the only or best filter to use, you can only use filters that, for instance, in this situation, you say, okay, I actually ran this research once. I mean, maybe one of the first things I ever did was what happens if you buy bonds when the ATR is less than a point? And it's much better if the ATR was less than a point versus higher than a point, 32 ticks. Okay, so the problem with that is there will be a trend, and the markets can change, where there can be monster trends where that filter, strict adherence to that filter, will keep you out of a really big trade. This is life. and this is like runs through all the philosophy of trend following. This whole idea that you can't really pay too much attention to the back test, especially if you come up with some fancy rules that keep you out of trades. So what you have to do then is say something like, okay, I'll buy the 50-day high if the ATR is low or it meets my entry criteria, but once it gets to the 100-day high, I'm just going to get in. Yeah, you have to do something like that. And we were doing things like that in 1984. Okay, so this is what you have to do. Now, of course, I'm sure that the results of that backtest are not as good as tweaking that ATR, torturing the ATR calculation over and over to find that's perfect. Okay, so if 32 ticks doesn't work, let's make it 34. Now it works perfect. So now we know the magic number. We don't ever trade the bonds if the ATR is greater than 34 now. So this is bad thinking. You don't want to do that. But you do want to have, so this is why these filters are of limited use, because you can't have a filter that filters you out of a big, huge monster trend, regardless of what the back test says. Okay, so go ahead.
Well, I
All
wanted
right.
only to say, that these filters, in fact, when we use so much filters or some filters that can filter us out from a big trend, we are predicting. It's against our philosophy to predict. We are predicting maybe based on a back test, but we do something that can lead to something that we will miss a trade, and this is a prediction model. So our filter, I fully agree with Jerry that we can have a filters, but these filters they must not there must not be a probability that we will be filtered out from a big trades, because really we can see something unpredictable, and we will sooner or later, we all know this, I think, we will see something unpredictable and unexpected, and these complex filters, they will not work, and we will miss a monster trade, especially if we were trading in a long-term space. It's a bigger problem, and even in the
Okay, let me finish my thought, Oleg. So then I write, when VIX is very high or VIX is very low, trend following performs well. Okay, so basically, other markets probably, okay, I'll just keep going. For the high vol regimes, historically, the outperformance comes from fixed income, whereas in low vol regimes, it comes from equities. Exactly. Back to the same idea, which if when the volatility is high for stocks, then the other low vol market, the other sectors, currencies, commodities, and interest rates, would have a tendency to have lower vol, and then that's where the profits are going to come from. The profits are always coming from these lower vol sectors. But it goes on to say when the stocks themselves have a low vol, then the overperformance comes from stocks themselves. Right. So this is sort of a classic pattern of you have this consolidation, you have this choppiness, you have these false breakouts, you build in this base, and then the vol is low, everyone hates the trade, you've lost money in it, everyone's bored with it, no one cares about it, the ATR is really low, boom, the next breakout, upside breakout, downside breakout, that's the one you want to keep. The expectation is building with every losing trade. And so this is where you want to hit this trade. But if the volatility is high in the equities, then you're more likely going to get this great performance from the other sectors who would have the potential to have lower volatility than the stock fixed volatility, the stock volatility. So this is just kind of like, it's kind of old news, kind of interesting. They found that each and every asset class performs the best in its trend following formulation in the respective low vol regime. Equities perform better in the low realized volatility of equities. FX performs better in the low realized volatility of FX, and so on and so forth. Yeah. So once again, I think This is good to know. It's good. I kind of used this and stuff, but in a very limited and non-optimized way, because by any sort of filter that I would use, it doesn't keep me out of a trend. So it doesn't test out as well as optimizing on vol. Okay, does anybody have any comments or any sort of contradictions to, do you like vol? Good morning, Absolute. How are you?
Hey guys, how's everybody? Yeah, I'm doing pretty well. So I just had a comment on the Quantica paper and on the comment. I think the explanation is much simpler than the paper tried to explain, or just to find why things are the way they are. So why are equities performing well when volatility is VIX is low, and why bonds are performing well when VIX is high? This goes again with the risk on, risk off paradigm. And basically, low vol means the fiat money printing central banking environment is good, everything is fine, inflation is regular, money is being printed on a regular basis, everything is just going up. When everything is going up, you just need to be long most things and you will be making money, especially if you put on leverage like CTAs do. So when volatility is low, that means the predictability of central banks is high. And that means their targets of 2 or 3% inflation, which is always a lie. The money supply always grows at higher percentages of current money quantity than the CPI number is showing. So everybody knows that new money is being created to create peace, to lower the VIX, to lower volatility. Everything is predictable. And in this environment, it pays to be leveraged and long pretty much everything. Stocks, whatever, everything is kind of going up. And then in those shorter periods of times when VIX explodes, when volatility of equity goes higher, that's when the balloon kind of bursts to one extent or another, whether it's a recession or there's a bump in the road. And when the bump in the road goes, everybody goes into safe assets, into risk-off assets, which means long bonds. But whether VIX is low or whether VIX is high, the longs are making the money. When VIX is low, the longs in stocks and risk assets are making money, and VIX is high, the longs in bonds are making money. So the explanation with all this volatility discussion, and for me, it's very simple. Whatever asset goes up, and the trend is up, you make more money because, and this is confirmed with a test that we've been running with if we do backtests, like, we discussed this before. We make much more money on longs than on shorts, and there's a reason for it. And the reason for it is the fiat system that we've been living for the last 50 years in a turbo mode, and we don't know when that's going to happen. Within that system, we've had different regimes. And when somebody builds a robust strategy, I built a strategy that can sustain high VIX, low VIX, up stocks, down stocks, whatever. So you think you're kind of covered all regimes, but I think that's an arrogant statement to say that you have built a strategy that is anti-fragile or resistant to all possible regimes. That's a very, very powerful statement to make. It's very hard to build a system that is robust to all possible regimes because we don't know what the possible universe of possible regimes are. We all are enveloped within a world in which I don't know how to explain it. So basically, to cut the long story short, my explanation for the low VIX, high VIX conclusion of the Quantica paper is basically whatever is going up, whenever the trend is up in asset X, you make money. If the trend is down in asset X, you don't make much money in it overall in all assets. And lucky for us, over the last 50 years, overall, everything has been going up because central banks have been just created fiat money.
Absolutely. Can I ask you a question?
I agree with all of that, and And thus, that's my whole idea of don't pay too much attention to those equity stats or discount them dramatically. Things will be worse than the equity stats. Concentrate on your trade stats. And regardless of how great your system is performed or the backtest, get ready to always never trust it in the sense that something can't go wrong, and get ready to do that cutback and trade smaller. So I agree with all of that. You want it to be, and then I think that another, obviously, another way that I think the evidence we take it seriously is that I'm perfectly happy congratulating and allowing others to use more rules and more parameters and use the current equity as their trade level and congratulate them when it all works out great. I can't do that because it's just my own. I'm going to embrace. Thankfully, there were people encouraging me to embrace and to tell me it was okay to be overly concerned about those issues. Sorry, Kodura, go ahead.
No, thanks. I agree with you. I just wanted to ask, Absolute, when you say that we know that there's more money to make, or we make more money on the longs than on the shorts, you're speaking about every strategy, trend following in particular, and especially, are you talking about nominal or real, or is it the same for you?
I mean, listen, if you look at all markets, like all charts over the last 50 years, it will be clear to you what I'm talking about. So if you have a universe of 100 markets, 200 markets, 300 markets, and just browse through back adjusted or whatever data, just look at the price series over 50 years of all those markets. It will be evident to you that they go more up than they go down. And that if you do want to make money on trend following, bulk of your money will be made on the long side because everything has been going up.
No, I understand. It's just that, for example, in the interest rate markets, in short interest rates, you will see that you make money on nominal terms, but due to financial regulation by central banks, you actually lost money in real terms in the last 15 or so years. So I just wanted to understand if you think that it's indifferent to the inflation regime, or you're speaking just in nominal terms, because in nominal terms, it's clear that it's a discount rate issue that made everything go up. But I wanted to know your opinion about if it's the same on real terms, which is the most important thing.
No, I mean even short rates, you make money if you do a backtest, like a back adjusted series of short rate futures. They're going up too over the last 50 years.
Okay, so you're speaking on trend following trades made by trend following systems.
Listen, any system that you trade is going to trade on the same price series. If you trade futures, you're going to have to trade some kind of a back adjusted series, depending on what your system is, as we talked before, maybe an hour ago from the beginning. So if your PNL and volatility or signals is calculated on price differentials, you back adjust it with the price back adjustment, price difference. If your system trade and PNL is based on percentage basis, your back adjustment will have to be percentage wise back adjustment. So your back adjustment, creation of back adjustment series, i.e. data prep, has to be adapted to your strategy. So it doesn't, I'm not only talking about trend followers. Once you adapt your price series to the method and to the system that you're trading, that price series will be, as you buy something and sell something on that price chart, that will be a true reflection of your P&L.
Yes, but for example, if you take the 3 month, let's say just a buy and hold. If you see the treasuries, the 3 month treasuries from 2008, you will see, as you say, that it went up because interest rates went down, etc. But when you adjust it for real returns, you're losing money for 15 years. That's why I wanted to know if you were speaking about nominal terms or real terms.
I'm talking about traders' terms. So basically, and I will not trade an instrument, I will not trade a price series that would not be a true reflection of my P&L when I buy a certain point on that chart and sell a certain other point on that chart. For me, those price series are useless. So if you're looking at a chart, is it interest rates or nominal or something that doesn't include carry costs, that doesn't include uh, currency differentials and whatever, then you're trading a ghost. So this is why data preparation is very important. Why Medallion has like 50 PhDs only preparing data, building their database so that it's consistent with what a trader would trade. When a trader asks for show me soybeans, or give me, I don't know, Chinese this or that, or this stock, he expects the price series that he is given, that price series, that chart that he sees, when he buys X and he's at certain point and he sells it at another point, if the other point is higher than the previous point, he should have made money. If he is buying one point lower point on the chart and selling a higher point on that chart, but he would have lost money in real world, that chart is useless.
Okay. I think we're talking about different stuff, but maybe it's I cannot explain myself.
No, I'm talking exactly. I'm addressing what you're asking me. So this is why I'm addressing. This is why it's important. It's important to trade a price series which is a true reflection of your P&L if you just held it. So let's say you're not trading it, but you have a price series that's showing 10 years. Okay. So if according to your system, you bought this thing at the beginning of the chart and you sold it at the end of the 10-year period, the price chart would be a true reflection of your P&L if you did nothing. So if there's something else in that instrument or in that market that is subtracting or adding to that P&L, then you're trading a ghost. Then your backtest is useless.
Yeah, that's why I said inflation adjusted returns, because in the end, if you, for example, see the treasury bills from 2008, you will see in nominal terms that you have, if you invested $10,000 in 2008, you have like $2,000 more today. But that will not be useful for buying the same things that you bought with 10,000 at the beginning of the period. So that's the difference between nominal and real returns. I wanted to ask you that if for you it's the same, whether on nominal or real terms, if you're making money on longs. In the case of treasury bills, it's clear that in nominal terms you earn money because everything was subdued and interest rate went down, but actually you lost purchasing power, which I think is the most important thing at the end.
Well, it's in terms of treasury bills. Okay, so you can't. Our measure, our equity curve, our performance is not inflation adjusted, right? So nobody is doing inflation adjusted equity curves, as far as I'm concerned. So S&P.
Well, but it's important, isn't it? I mean, maybe you won't chart them, and I know that most people, I agree, show nominal returns. But in the end, if your inflation-adjusted returns are not good enough for you to survive the same way that you used to do when you started, then and I mean, one of the great selling points of trend following is that they are a great inflation hedge. So that's why I was asking that.
It doesn't really matter.
It
doesn't really matter, Cordura, because the inflation will be the same for any asset you're trading. So if you're subtracting
I know
three,
that, Bruno,
four,
but
whatever
I mean,
percent, it doesn't really
no,
matter because you're subtracting
I
from the
understand.
same return streams.
No, I understand that, but when you see the return streams in the past and you adjust them for inflation, you will see which strategies work worse or better when expected inflation rises.
Yeah, I see where you're getting from, because I myself come from a country where inflation is a problem. But in the end, when you're comparing return streams, it doesn't matter. It's just a layer of complexity that you're adding, or not complexity, but of complication that you're adding to your comparison. It doesn't matter because the inflation will be the same if you're investing in trend following or if you're investing in whatever other strategy. What you want to see is which one gets a better return. Then you subtract the same inflation rate from that return, and it really doesn't matter if you're subtracting um, because it's the same number for all strategies, you know.
Cordura, let me answer you more universally. Like if you're trading all four asset classes, and let's say inflation is, I don't know, 5%. If 5% real inflation, money creation inflation, everything is 5% every year. And if you're just mostly long all assets without leverage, yeah, you're gonna kind of protect yourself from inflation, and you're gonna make 5% a year. And if inflation is 5 years, you're gonna break even. If you don't do that, if you're not long all these assets without leverage, then you're gonna lose 5% a year if you keep your money in a bank. So just as a protection from inflation, being mostly long all these four asset classes without leverage, you're going to protect yourself from inflation. Where the good part comes for us, for trend followers, CTAs that they can trade futures, we are allowed to apply leverage. So just like guys who are buying houses and that's their only leverage position they can put in their lives, like normal people who don't trade or whatever, that's their only leverage position they can put. They can protect them from inflation and leverage. Because it's leveraged, their equity in the house is growing higher than inflation, and that's how they're kind of beating inflation. But we can do that with almost everything else in the world that's going up at 5%, let's say. So if you put leverage 4 times, you're making mostly 20% a year. So you're basically ahead of everybody if you can make the 20% a year at 5% inflation. Why? Because you can put 4 times leverage, 10 times leverage. You can put as much leverage as you want if you don't blow up. So this is the benefit. And this is why we're mostly making money on the long side, because there is inflation and because we can apply leverage to not just protect ourselves from the inflation, but to actually profit from it.
Yes, I agree with you guys that in the end it's the same when you subtract inflation or you compare inflation to multiple asset classes. Thanks. I was just thinking about the non-linearities or the usefulness of things like trend following when you want to protect yourself for inflation, as you said, which is very useful because you can use leverage and you can get outliers and diversify. Thanks.
Okay, I want to move on to more Top Traders Unplugged. And since I'm not on the show, sitting there, putting in my comments after everybody speaks, I have to do it on Friday morning. Okay. Here's a quote. Most large CTAs use dynamic position sizing related to volatility and correlation. I don't think they would all have come to the same conclusion if it was damaging the overall returns. I think the evidence is on the side that dynamic position sizing is better. The majority has ruled, but they used to say, I don't see much difference between the two. The position sizing, I compare the returns, they're kind of the same, blah, blah, blah. Well, okay, now a different position here that because here's the evidence, everyone does it, it's got to be better. However, I don't think that it's true that it damages the overall returns. I don't know. I mean, does it? I don't think that's the case. That would be an accurate statement. That I wouldn't make that statement. I think that what it does, is that the dynamic position sizing, it does help with the Sharpe ratio, and it smooths things out. It's like a take profit, though, and Doug Green admitted as much on a recent podcast, Floor and Court, that this dynamic position sizing, this vol management, really does help us take profit. So that's my contention all along. It's just like a profit objective, a rule-based profit objective based upon vol. If it does any damage, it might do some damage to the robustness because there's more parameters, more rules. But I think when you do the back test, it definitely makes the Sharpe ratio better. and you leverage it up and you trade bigger, your average loss has to be a little bit bigger than classic because you're not participating in the long-term trends to the same degree, which is not a positive or a negative. It's just, it's in the same way that a shorter-term one entry, one exit stop loss system would not participate in some of the bigger trends in the same way that a longer-term similar system would. Doesn't mean it's not better. You just leverage it up and trade it a little bit larger to make up for that difference. Now we're getting, he's getting more into the Quantica idea here now. My simple observation is that when trends are strong, volatility tends to drop and therefore shouldn't penalize position size. Volatility tends to increase around turning points, so it makes sense to reduce position size. We're not going to get into that debate today. Oh, oops, we already got into it. And I think this is not exactly the way I would word it, but as we said earlier, and as the Quantica paper sort of confirmed, when a lot of the benefit of low volatility comes for CTAs in terms of bigger position sizes at entry. The ATR is low, the position is going to be bigger, and then that's going to make for a more profitable trend. I think when you put these positions on, maybe the vol stays sort of similar or drops a bit, but as the trade gets going, like in the bonds of last year, the ATRs at entry were so tiny and small, then they exploded. And so most of the time when you have these big trends, at least near the end, as he sort of says, volatility tends to increase around the turning points. I think it increases multiple times before the turning point. That's another one of my points, is that yes, you can look back and say, oh, there's the turning point. Number one, let's identify the turning point, which can only be done in hindsight. Step two, has vol increased? Yes. There's no information there. That's without information. Because when vol increases prior to the exact turning point, that's a false positive. So you wouldn't want to get out there. What is a better indicator of a turning point? Is it trend or is it vol? They would say probably both. I would say trend, especially if you don't use Sharp to measure performance. Any comments on that?
I have the opinion that we can't predict anything, and turning point also because I think, for example, I like the words of Moritz that people who predicted turning points, they would close their position their longs in OIJ in 250, because if we look historically, if we do the backtest of the market, if we use all this approach, it's this logic. I think maybe I've understood the subject in the wrong way, but I think that my opinion that maybe it's another topic. But I think that the only philosophy, the only way of doing this for me personally is not to predict anything. I think that's the best way, and OJ is a very good evidence of recent situation where we see the trend in OJ. Nowadays, we have seen what have been with this market for 2 years, and theoretically, the same situation. We can see the same situation with every existing market. So I don't see, for me personally, the reasons to predict the turning points. Here's my position.
Hi guys. Hey Jerry. Hey everyone else. I mean, in terms of the negative future prices in the backtests, that happens if you have a very long dated futures contract. So on those particular futures contracts, it's just happening handful of markets in my continuous futures contracts. So I'm using percentage based stitching only for those, because I don't want to be dealing with the negatives, and all the rest of the portfolio is using just a simple addition or subtraction. But I just thought that the difference is just not going to be material, and I don't want to be dealing with the negative prices. So that's my process there. And Maurice was talking about the challenge in the trading conditions for long-term traders, and this is this is a turning point. So the short-term trends are strong on the turning point, so there are no surprises there. So I'm able to pick up a lot of trends on the market bottoms, like EU credit, and I'm not wall managing. So I picked up those EU credit positions and equity positions. So if I would have been using any sort of volatility filter, I would have gotten into those trends later on, because when the S&P rallied in the first, if you remember, it was going up, bang bang bang, 4 or 5 days. So I was just picking up single names on those days, just by virtue of not using any volatility as a filter there. I'm finding the behavioral biases is a big thing for me. It's just when you get everything else right, you still you just still remain with your brain, and so you're just on your own with your brain. Okay, and this is money management is a very long-term game. Okay, so it's really, who cares about this week, this month, this year, or even next 10 years? So with that long horizon in the future, the only thing that you have to manage is your behavioral biases. So whether you're gonna exit early, and that's the main thing. Now I'm following a lot of traders, and they are talking about selling into the strength. Okay, and they're saying that it is easier because you don't have to deal with the profit give back. And they say, I'm not going to deal with the profit give back, I'm going to sell into the strength, my drawdowns are going to be less. But what is happening is, when the profit target becomes the moon, when things actually, go very high, they are watching it from outside. So what I am doing as a trend following trader is, I do not have a profit target. So these trends can go, to the moon pretty much. So when this is happening, of course, there's a profit give back at the end. So when the trends ease back, I need to deal with that drawdown that is happening at the end of my trends. So there's a trade-off in approach there, and I think that tells a lot about different traders and how they are approaching the exit mechanism. Are they really are, are are they willing to watch the markets heading off the new highs, or they would rather deal with the drawdowns? I think there's a trade-off there, and trend following approach of allowing the maximum and there is no glass ceiling on top of any of those trades, so they can go wherever they would like to go. So that resonates with me and with my psychology. So I like that, but still it is difficult. Still there are behavioral biases. Still I need to deal with my own brain. Still things has to happen between my 2 ears. So there's that. And and the trading single name stocks is hugely liberating. I need to I'm grateful that I'm able to ask so many questions to Jerry Parker. I mean, at the beginning of the year, I wasn't trading single name stocks. I didn't have a clue on trading single name stocks. So, and I'm looking into index trading versus trading single name stocks. is hugely profitable. The majority of the profits are coming from trading single name stocks in my portfolio. So that's very important, not to trade the indices. Would you be rather be trading the S&P 500 now? No, of course not. So a diversified portfolio is very important with different sizes, and then there are different countries to be added to that as well. It's a very powerful thing to be able to trade single name stocks. Not to use volatility. It's very powerful. Why you want to use volatility and trade indices? I think these, whatever is easy. Okay, if you go from that route, then your returns are going to be lower. So if you really want to shoot for the highest returns, then the rule is going to be naturally more difficult. And you might guess whom I've learned from it. Again, it's Jerry Parker. But that's how it is. And if you're trading in a market like this, so the other thing is this middle of the trend conversation. I mean, if you want to enter on the middle of the trend, there's no sample size. Okay, so if you're gonna do a no sample size move, like entering in the middle of the trend, establishing a new fund, establishing a new trading program, or cutback rule, or reversing the cutback rule, these are no sample size moves. So it's a gamble. So and that's a key differentiator of the performance. There are lots of benefits in dealing the situation as Moritz does it. He says, I want to come back to that portfolio now. Or you might say, I want to come back to that portfolio now, but I would like to put half of the position size because, just in case if things may reverse. Or you might say, okay, I'm going to take those positions. I'm opening up. I don't have any position. The backtest is trading those positions. Maybe I can, and I would rather add positions one by one. This has been my approach so far. So that's another way of dealing with it. But it's because there's no sample size, the application among different traders are going to be different. So there's no hiding about that. And I'm a big believer that there's always a trend following portfolio somewhere else that is going all-time highs. So if it is not my portfolio, it's possibly someone else's portfolio. There is always something else happening in the liquid assets, either in the developed countries, emerging countries, or in the frontier markets. So yeah, it is. And which portfolio to trade is also a gamble. It's because there's a world liquid assets that from African markets to Asian markets to European and US markets. So you cannot trade everything else. Okay, so the portfolio construction is hugely biased, but this opportunity is there, and I would say it's a very interesting time to be a trend following trader. The number of opportunities are hugely increasing. There are new markets are coming, new opportunities are coming. And the month of December is a very big sign that is possibly there are going to be good trends at the beginning of the next year. Either in the credit space, those bonds may continue to go up, or equities may continue to go up, or the FX, crypto. Some commodities are interesting for sure. The sugar short. Wow, what sort of a trade is that, isn't it? So it's just going down and down and down. So yeah, I mean, I would say it has been an eventful December on my end, and now I'm just looking. I'm just curious what sort of a January is ahead of us. Right. That's all. Thanks a lot, guys. Cheers.
Thanks, Alp. That's good. I agree with all of that. I did want to ask you a question about a tweet that you had. I didn't understand this tweet. If there is no religious system exit, I sometimes like 50% exit. This ensures minimal regret. If it goes up, you have 50% to ride further. If it stops out, you already recognize 50%. It does not sound like Alp to me.
Yo, yes. It's not something else I do. But I happen to be a trend following trader first, and then I am learning trading second. So some people learn trading, then they become a trend following trader. My journey has evolved in such a way that I've spent 9 years to be able to learn coding and technology. I didn't know much about trading, and I spent 2 years here in Spaces to be able to learn trading from Jerry Parker and all these established guests here. And now I'm going into and reading books about how does the other non-trend following guys do it, and these are the rules that I am reading about it, but I don't apply for it. No, if I have an early exit, if I don't wait for it, then this means that I'm not following up my system. So that's not what I do. But it is also educational to understand why other people are selling into the strength, because they don't want to have the give back at the end, and they would rather watch that stock go to the moon while I'm riding that stock, while my account portfolio is while my systems actually maximizing those profits. And this is what my systems does. So my systems maximize those profits. So these profits just go up and up and up and up, because I am on that, on those markets, and those breakouts are beautiful. They just maximize it. But the other guys, of course, they do have a different approach to life. So their psychology works different. And I think that's the trend following way. So trend following says that you do not have to put any glass ceiling on your head. So, and that's, that resonates with me, and that's a choice. Thanks a lot. I hope it makes sense, Jerry.
Okay, I like that. Well, I don't have anything else. I think I need to go do some Christmas shopping. And but if anybody has a question or a comment before we leave, feel free in these remaining 30 seconds to raise your hand or ask a question. We'll be back at it next week. Oh, of course, 29th. What a magic time I got to spend with my grandkids and children this past week. And then I'm looking forward to a sunny, no snow Florida. Back to the warmth with my puppies and birds, who I love dearly. And good luck to everybody on the trading and sticking to your systems, coming up with better ways to do trend following. It is the best. You're at the top. If it wasn't true, I would tell you, and I would not do it. And my whole, I'm pretty sure I said this on the latest podcast, Better System Trader, which I really enjoyed that podcast, is that, really the only mistakes I've ever made in trading were to trade too large and not follow my system, regardless of how average it was at the time. It just takes practice. You just got to suffer and practice following it and failing at it, and risk small amounts of money in the beginning, so your tuition costs are low or reasonable. All right, everyone, have a good weekend. See you next week.